Welcome to another accounting video in which we're going to look at acquisition of property, plant, and equipment. The exercise we're going to review is going to go over journal entries. So let's take a look at the exercise and see how we would structure each of these journal entries. So in this exercise, we have Kelly Clarkson Corporation that operates a retail computer store. To improve delivery services to customers, the company purchases 4 new trucks on April 1st, 2020. The terms of acquisition for each truck are described below. So we have 4 separate acquisitions. So we're going to do 4 different journal entries, and we'll see what's unique about each of these transactions. So in the first case, they tell us truck number 1 has a list price of $15,000, and it is acquired for a cash payment of $13,900. So we always record the journal entry at the acquisition price. The list price is what the seller has it at. We don't care about that. It's what we paid that we care about. So we start out in the journal with our date, and we debit our asset account. In this case, it is truck number 1. We debit it for the $13,900 that we paid. So in this transaction, it's fairly straightforward. Cash is going to be credited, $13,900. On the same day, we purchased truck number 2 that has a list price of $16,000. It's acquired for a down payment of $2,000 cash and a 0 interest-bearing note with a face value of $14,000. The note is due on April 1st, 2021, which means it's a 1-year note. Clarkson would normally have paid interest at the rate of 10% for such borrowing. The dealership has an incremental borrowing rate of 8%. We're doing the journal entry in the books of Clarkson, so we don't care about what the dealership's incremental borrowing rate is. We care about our incremental borrowing rate, which is 10%. So we need to discount the note, the $14,000. For 10%, the number of periods is 1. So it's the same date. We're going to debit truck number 2. What we know over here is I've signed a notes payable, and I have paid cash in this transaction. So the cash I paid is $2,000. I know that amount. I've signed a note for $14,000. I need to find out the present value of the $14,000. I will add that to the $2,000 to find out what the truck should be debited at. So for this, I will need to look up my time value of money tables. And the factor I come up with is 0.90909. So 14,000 times this discount factor, I come up with $12,727. That plus the $2,000 is the carrying value, is the present value of this note. And the discount on notes payable is going to be $1,276. So again, let's go over this once again. I paid cash of $2,000. The face value of the note is $14,000. The present value of the note is $12,727. I add $2,000, the cash that I paid, to that, and that gives me what I'm going to debit my my truck at. So the truck is, it is recognized at the present value of the note plus any cash that is paid. The difference is the discount. That's basically the interest on this. And here I'm writing a note to myself, and I'm saying the terms are 1 year, 10%, so I can explain how I came up with these numbers. Now let's look at the third truck. This truck has a list price of $16,000. It's acquired in exchange for a computer system that Clarkson carries in inventory. The computer system costs $12,000 and is normally sold for $15,200. So in this case, what we're looking at is I made a sale. Instead of getting cash, I got a truck. So my journal entry, I'm going to have truck debit. I'm going to credit sales. So instead of cash debit, sales credit, I'm going to have truck debit, sales credit. I'm using the perpetual inventory system. I'll have cost of goods sold debit and inventory credit. What do I carry this in my books at? $12,000, the computer. So this journal entry is fairly straightforward. It's for $12,000. The next question is, how much should I credit sales? How much should I debit the truck? The 16,000 or the 15,200? If you recall, I told you that list price is just a guiding number. That's not what we're going to go with. I know the value of the asset that I'm giving up. What I could have sold it for is 15,200. So this journal entry is going to be at 15,200. So always, if I know the value of the asset that I'm giving up, the exchange price, then that's the number I need to go with. So I know what I could have sold my inventory at, 15,200. So that's the number I'm going to go with. Finally, truck number 4 has a list price of $14,000. It's acquired in exchange of 1,000 shares of common stock in Clarkson Corporation. So I am giving up stocks. The stock value, the par value is $10 each. The market value right now is $13. So again, in this case, I'm going to debit my truck account, truck number 4. What I have given up is common stock. How many shares did I give? 1,000 shares. The par value is 10. So that's $10,000. The market value is 13, which means I could have gotten $3 extra per share if I had sold it. So 1,000 times 3 is $3,000. That number is paid in capital in excess of par. So the truck is going to be debited at $13,000. Again, I'm not going to look at the list price. I'm going to go with the value of my stock, $13 per share. 1,000 shares were given in exchange for this truck. So here we have an example with 4 unique situations. The first one we paid cash. The second one we paid cash and signed a note, which obviously means there's interest over there, the 10% interest. The third one, we gave it in exchange for inventory that we normally carry. And in the last one, we acquired the truck in exchange for common stock. That is our stock. Instead of selling it to the public, we gave those stocks to this company who gave us the truck. So these are not uncommon. Most transactions are going to be cash transactions, or they're going to be a credit transaction or some combination thereof. So the first 2 examples that we have over here, these transactions are most common for most businesses. Number 3 and number 4 are not uncommon. It does happen, which is why we've gone over this. So once again, this is another example of how we capitalize the asset. These numbers are important because each of these trucks have to be depreciated over their estimated useful life. I need to know how much I should be depreciating. So if it's a cash transaction, it's very clear. Otherwise, I need to look through it very carefully and come up with the correct number. So with that, we end this video, and we're going to look at yet another example in the next video of another type of acquisition.